All right. Well, welcome back to the iWealth podcast. And we did an event yesterday. Brad was doing a little guest speaking there at your event. And you got a hand, and a guy asked about a treasury.
Right.
And then had questions around that. And you had a really cool answer. So I wanted you to talk about that.
Yeah, and if I recall right, I mean, the question was surrounding, like, he read an article and it was a 2-year Treasury note. And he's like, why did it say in the article that it was guaranteed or it was really safe investment or something along that lines? And then is it a bond or what's a bond, that kind of thing. And so I started out by just saying, listen, a bond is a loan. And so, stocks you own, you have equity, you have a Walmart, you invest in Walmart stock, you own Walmart stock, and you own a piece of Walmart. When it's a bond, you're loaning money. And so Walmart has bonds. And so you could give Walmart $10,000 and they would pay you 6% interest, let's say, for 10 years, and then return your $10,000 to you. That's a bond, and they're safer than stocks. So his question around treasuries is, why is the paper saying that's safe? Like, what about the Walmart? And a treasury is a government bond. It's a loan to the U.S. government. Mm-hmm. And so if you take the same $10,000 and you give it to the U.S. government and you do a 10-year note, and maybe that 10-year note is paying you 4%, but Walmart's paying you 6%. Why is the difference? It's because there's more risk. Walmart could go out of business and you don't have your money anymore. It's a loan, but they got to pay other people back before they pay you back, and if they go out of business. But if it's a government bond, the government can raise taxes. The government can cut some other type spending, and maybe.
Or they could just print some more money.
Exactly. So it's a safer investment in a U.S. government bond than it is in an individual stock company, where all your bond money's in one stock, where something could happen to that one company, however you want to say it. So it was a really good question, because I think a lot of people, first of all, just the concept of a bond versus stock. Secondly, why are some safer than others? And so I thought it was a good conversation. Is that what you pulled yesterday too?
Yeah, and just the idea that the government has a get-out-of-jail-free card on some level versus if you invested in a business, they don't.
Right.
If they're done, they're done.
Yeah. And the level of risk just depends on there's junk bonds out there that might be paying 8% rate of return. And junk bonds are low-rated bonds, so companies that are small, maybe cash flow is tight, and you're taking more of a risk. And I kind of look at it as like Guido or the mob or something. If you're going to give somebody some money and it's risky, you better get a better rate of return on it, because you're taking more risk for that loan versus the government. You're just not taking a lot of risk. So it's interesting.
Very cool. We'll see you back here next time.
All right. Thanks, Matt.